In this video, you will learn the best moving average trading strategy. In this video, you are going to master the moving average trading strategy and know how to trade it profitably in the forex market. This is the best strategy that any forex beginner can start with because it is the simplest trading strategy that you can master, and once you are able to master it, you'll be able to make money profitably in the forex market. So in this video, you will also learn how to combine the moving average alongside with price action to get a high probability trading setup. So once you master this strategy, you will be able to make money consistently in the forex market. So my advice to you guys is to make sure that you watch this video from the beginning to the end. Don't skip any. Make sure you watch it from the beginning to the end so that you will understand what this video is talking about. So right now we'll head straight to the meaning of a moving average. Before we start, what is a moving average? A moving average is a technical indicator that market analysts or investors may use to determine the direction of the market. That is to say, a moving average helps forex traders to determine the potential direction of the market. The moving average helps investors and traders to be able to identify the potential direction of a trend and also increase their chances of being profitable in the market. So a moving average is an indicator that is applied to a chart that helps to smooth out price by removing the fluctuations surrounding the price movement in question. So a moving average is one of the best technical indicators out there that so many forex traders are using to make money consistently in the forex market. We have so many moving averages. We have so many moving average. We have the exponential, we have the simple, we have the weighted, and so on and so forth. But the most popular of them is the exponential moving average. Why is the exponential moving average so popular? It is because the exponential moving average helps to smooth data price. It tells us what is currently happening in the market. In other words, you can call it the EMA. So many traders are using the exponential moving average because it is closer to the price compared to other moving average like the simple moving average. So they use it to be able to analyze the trend, to know the directional movement of the trend, whether the market is going up or going down. So the reason why an exponential moving average is used and preferred by many traders compared to other moving average like the simple or weighted is because it places more weight on recent data point, that is recent prices. It is closer to the prices. It adds more weight to the recent prices compared to the others. Like the simple moving average, if you plot it along with the exponential, you see that the simple moving average is far away from the price, while the exponential moving average is closer to the price. So that is why many traders prefer to trade with the exponential moving average compared to other moving average. So before you start trading the moving average, there are periods that you need in your settings. So we have the 20 EMA. The 20 EMA tells us that the market is in a strong trend. We have the 50 EMA. The 50 EMA tells us that the market is in a healthy trend. And then we have the 200 EMA. The 200 EMA tells us that the market is in a weak trend. So when the market is in a strong trend, the market makes little pullback, and that is why the 20 EMA will help to catch the pullback. But if the market is in a healthy trend, the market will make a little pullback, but this time around the pullback will be a little longer than the 20 EMA. So the 50 EMA will help to catch the pullback. So when the market is in a healthy trend, you can use the trend line and the 50 EMA, because when the market is in a healthy trend, the market will be crossing below or above the 20 EMA, right? So the 50 EMA is what will be holding onto the market, right? So the 20 EMA is used when the market is in a strong trend, while the 50 EMA is used when the market is in a healthy trend. Then the 200 EMA is when the market is in a weak trend, when the pullback is very deep. So you can use the 200 EMA when the market is in a deep pullback. So the 200 EMA is mostly used by institutional traders, banks, and big companies, because with the 200 EMA you can be able to know what will happen, because they use the 200 EMA to see the longer trend in the market, right? So the 200 EMA is used to see the longer trend in the market. That is why position traders and swing traders use the 200 EMA most of the time, while day traders use the 50 and the 20 EMA. So that is why the 200 EMA is very important, because traders see it as an opportunity to know the direction of the market. So whenever there is a crossover above the 200 EMA, the traders knew that a trend have changed, right? So the 200 EMA is being looked at a higher time frame, while the 50 and the 20 EMA are being looked at a lower time frame. So these are the periods that you can include in your moving average. You can use other periods that you like the 10 period, the 25, 23, 30, but for the sake of this video we are making use of the 20, 50 and the 200 as an example. So like I said, the 20 EMA symbolizes or signals a strong trend, the 50 EMA signals a healthy trend, while the 200 EMA signals a weak trend. So now what do we use the moving average to identify? The moving average helps us to identify a trend in the market. It helps us to identify if a market is in an uptrend, if a market is in a downtrend, or if a market is in a sideways that is ranging. So if the price is above the moving average, it means that the market is bullish. It means that the market is in an uptrend. If the price is below the moving average, it means the market is bearish. It means the market is in a downtrend. But if the price is crossing the moving average up and down, up and down, up and down, it means the market is in a sideways or the market is ranging. So this is how you can use the moving average to know the directional movement of the market. So you cannot trade the moving average alone. It is not a standalone indicator. You must include it with price action. So you don't trade based on the signal from the moving average. You use it to identify a directional movement of the market, then you now include it with your price action trading strategy. So the moving average can be applied to your price action. That is why if you combine the moving average with price action, it will give you a higher probability trading setup. So that is why I will never ever advise you to use the moving average alone, because if you use it alone, when the market began to range, you will get so many whipsaw, and this might wipe out your account, because when the market is in a range, the moving average will get so many crossover, and if you are trading based on crossover, you will get so many whipsaw, and this might end up blowing your account. So that is why you only use the moving average as a mean to identify market movement, right? So the moving average will help you as a guide to understand the directional movement of the market, so as to know the direction that you are trading. If you are going up, you are going down, or if you are staying out of the market. So that is what the moving average will help you to do. So the moving average can also work as a support and resistance level. So if the price is in an uptrend, the moving average can act as a support level, right? So each time the price comes down to the moving average, it gets rejected and continue heading up. So buyers will be waiting at the moving average to take a buy trade, because the moving average in this scenario will be acting as a support level if the market is in an uptrend. But if a market is in a downtrend, the moving average will be acting as a resistance level, in the sense that sellers will be waiting to take their sell trade at the moving average. So each time price makes a pullback to the moving average, sellers take their sell trade, right? So you know that each time price is in a trend, it always makes a pullback before the trend continues. So if the market is in a downtrend, sellers will always wait at the moving average to take their sell trade, and if the market is in an uptrend, buyers will always wait at the moving average to take their buy trade. So in this scenario, the moving average is now acting as what? Support and resistance level. And also, if price eventually breaks above the moving average, it signifies or signals a new uptrend, the beginning of a new uptrend. If price eventually breaks above the moving average, it signifies the beginning of a new uptrend. And if price breaks below a moving average, it signifies or signals a new downtrend, right? And also, you can combine two moving average together to make up a strategy. How do you do that? You can plot two moving average and change the setting. For instance, you can combine the 50 EMA and the 20 EMA. So the 20 EMA will be the faster moving average, while the 50 EMA will be the slower moving average. So what you are going to do is you're going to change the color for you to be able to identify the two moving average. So you might change the color of the 50 EMA to black and change the color of the 20 EMA to blue. So what you will do is you wait for a crossover. If the faster moving average, which is the 20 EMA, crosses above the 50 EMA, it signals the beginning of a new bullish trend, a new uptrend. But if the faster moving average, which is the 20 EMA, crosses below the 50 moving average, which is the slower moving average, it signals the beginning of a new downtrend. So when you plot these two moving average, you wait for a crossover. So this is another strategy that trend followers are using, because you are trading in the direction of the trend. Why? Because if you are trading in the direction of the trend, you tend to make more money, right, compared to someone who is trading against a trend. Because if a market starts trending, it will only focus on that direction that it is going. It will make pullback, and the pullback are small, right? It can make like 20 or 15 pips pullback, and the trend continues. So you see that the people that are following the trend, or the traders that are following the trend, are the ones that will make the more money. So that is why when you are trading with a moving average crossover, you are trading in the direction of the trend. And have it at the back of your mind that moving average is a trend indicator, right? So it doesn't work during a ranging market, it works during a trending market. So once the market is ranging, the moving average crossover will give you so many whipsaw, and this might end up wiping out your account. And you can also use the moving average alongside with a trend line. So a trend line will stand as what? As a, should I use this word? A trend line will stand as a confirmation, right? If the price is in an uptrend and the price is breaking below the moving average but still heading up, it means that the price is not respecting the moving average that you are currently using. So that is why you need a trend line to connect the lows, so that each time price breaks below the moving average, it will tend to receive support from the trend line and continue going up. The same thing applicable if the market is in a downtrend and price is breaking above the moving average and still returning down. You can draw a trend line right, and connect the highs. Each time price breaks above the moving average, the price will tend to receive resistance from the trend line and continue heading down. So that is why I say you cannot use the moving average alone. You need to combine it with price action. So in this scenario, the trend line will stand as what? As a confirmation. If price eventually breaks above the trend line, it now gives you the confirmation that the trend have actually changed. So if the market was previously in a downtrend and makes a pullback and breaks above the moving average and still breaks above the trend line, it now tells you that the market have changed direction from a downtrend to an uptrend. So that is why you need to combine the moving average with price action so as to get a better trading setup. So combining the moving average with the trend line will prevent you from so many losses, because some traders, whenever the price crosses below the moving average, they might take that a change of trend has occurred. They will not take a sell trade because a crossover has happened. To their greatest surprise, the price would go down a little, reverse, and start going up, right? It means that the moving average at that period is not reacting with the price. The price is not respecting the moving average at that period. So that is why you need a trend line for you to be able to confirm the directional movement of the market. So once the market is breaking below the moving average and still going up, the trend line will save you. If the market is breaking below the moving average and still going up, the trend line will stand as a support. And if the market is breaking above the moving average and still going down, the trend line will stand as a resistance. So the moving average is so powerful that once you are able to master it, you'll be able to make money consistently in the forex market. So right now I'm going to head straight to the TradingView platform, and then I will show you how you can implement this strategy on a live account. So pay clear attention, because we are going straight to the practical aspect. You are going to learn how to use this strategy profitably. So pay clear attention. So now that we have explained everything about the moving average, how the strategy works, and how you can implement it, we are now going straight to the TradingView for the practical aspect, where I will show you a practical aspect of how you can trade with this moving average trading strategy. So we head straight to the TradingView. So this is the TradingView. Have it at the back of your mind that this strategy can work in any market. So we are going to test so many markets here. We are going to test so many markets. What we are doing is we are looking for a market that is worth trending, because this strategy works during a trending market, right? So we are going to use so many markets to explain this strategy for you guys to understand, because everyone has a particular pair he or she is trading. So the best thing I can do now is to explain it using different pairs, so that you see that the strategy gives the same results in all the pairs. So let's start with gold. Right? So you can clearly see here that the price is in an uptrend, right? From here the price is going up, and then suddenly the price began to go down, right? So this is a 1 hour time frame. For you to trade this strategy profitably, we need to go to the indicator. So you simply go to the indicator, you search for moving average exponential, and this is it. You click it once and it opens. So now we go to the settings. So the input is where you can change the period. Like I explained to you, we have the 20 EMA, which acts during a strong trend. We have the 50 EMA, which act during a healthy trend, and we have the 200 EMA, which act during what? A weak trend. So now let's start with the strong trend. Change the length to 20, method to EMA, and then you cannot change the length again to 20. So we can go to the style and increase the thickness. Then we click OK. So now this is the moving average, right? This is the moving average. So if you watch, you see that for the fact that the market is in an uptrend, the moving average is holding on to the price, right? the moving average is holding onto the price. Here you can see that the price crossed below the moving average and then return up. Again, price crossed below the moving average and then return up. So that is why I explained to you guys that you need a trend line in combination with the moving average. So in this scenario, you can clearly see that the directional movement of the market is up, but you can see that the price breaks below the moving average and still continue going up. So in this scenario, we simply plot our trend line and then connect the lows. So in this scenario now, the trend line becomes our last point. If the price breaks below the trend line, we cannot confirm that the trend have changed from an uptrend to a downtrend, because here the price was not respecting the moving average because the price is crossing below the moving average, right? So that is why we include the trend line. But what if we change the length, the period of the moving average from 20 to 50? Will the price respect it? Let's give it a try. So we go to the setting and then we go to the input. We now change the length to 50. We change the length again to 50 and we click OK. So you can clearly see, as for the fact that we have changed the length, you can see now that the price is now respecting the moving average. So what does it tell you? It tells you that here the market is in a healthy trend, not in a strong trend, right? Because you can see that there's a pullback here. The pullback, there's so much pullback here. So if you watch clearly, you see that when we plotted the 20 EMA, the price was breaking below it and then returning up. So this tells us that the price is not respecting the 20 EMA. So but if you don't have the 50 EMA, or if you're unable to change the setting to the 50 EMA, you can still use the trend line as what? As a backup, right? So if you watch, you see that the trend line was holding onto the price at the when we change the setting to 20 EMA, right? But the fact still remains that the price is in a healthy trend. That is why the price was not respecting the 20 EMA. So right now that we have changed the settings of the EMA from 20 period to 50 period, you can see right now that the price is now respecting the 50 EMA. So each time price comes to the 50 EMA, it gets rejected. Each time price comes to the 50 EMA, it gets rejected. Each time price comes to the 50 EMA, it gets rejected. Comes again, get rejected. The price comes again to the 50 EMA and then get rejected. So you can see that the 50 EMA is now reacting to the price. The price is respecting the 50 EMA because the market is what? In a healthy trend. So the trend line will now stand as what? As a support to the moving average, right? So the trend line will stand as the last point of defense, right? So if price eventually breaks below the trend line, we cannot confirm that the trend have changed. So you can clearly see that the price breaks below the 50 EMA, but we are not confirmed yet because the price might reverse. We are waiting for it to break below the trend line, and when the price eventually breaks below the trend line, we cannot confirm that the trend have changed. So you can see that each time the price is above the moving average, the market is always going up. So you see that the price is above the 50 EMA. You can see that the price is always going up. You can see the directional movement of the market up. And when the price eventually crosses below the 50 EMA, you can see that the price is now going down. So that is why I say the moving average helps us to know the directional movement of the market. So when the price is above the moving average, it means the market is going up. The bullish are in control. And if the market is below the 50 EMA, it means the market is going down. The bearish are in control. The sellers are in control. So this is how you'll be able to trade the market profitably. So let's now search for a sideways market for you to understand what I'm talking about. So here is a sideways market. This is a ranging market. So from here you can clearly see that in this scenario the price is ranging, right? The price is going up, coming down, going up, coming down, going up, coming down. So once the price is breaking below and above the moving average consistently, it means the market is in a range. So you can see that the price is breaking below and above the moving average. It's just going up, coming down, going up, coming down, going up, coming down, going up, coming down, going up, coming down. So this tells you that from here to here the price is consolidating. So when the price now began to respect the 50 EMA, that is when the trend now began, right? So you can see clearly that the price was formerly consolidating here. At this point the price was consolidating. That is why the price is going up, coming down, going up, coming down, going up, coming down. So the price is consolidating here. That is why the price is crossing above and below the moving average consistently. So this now signal to you that the market is clearly in a range. So you simply draw your levels, right? You draw your resistance level and then you draw your support level. And when price comes to the resistance level, you take a sell trade, and when price comes to the support level, you take a buy trade. So with the moving average, you are able to know that the market is currently in a range. So the buyers and the sellers are in equilibrium, right? The buyers are buying from the low, the sellers are selling from the highs. So with the moving average, you can be able to know the movement of the market. So in this scenario, we can conclude by saying that the market is in a sideway, the market is ranging. So let's look for another example. So this is another example here. From here, you can clearly see that the market is ranging. So you use your horizontal line to connect the highs and then connect the lows. So in this point, the market is ranging, right? From this point to this point, the market is ranging. So when the price comes to the resistance level, the sellers push it down, and when it comes to support level, the buyers push it up. Then when it comes to the resistance level, the sellers push it down, and when it comes again to the support level, the buyers push it up. Then the sellers push it down again, the buyers push it up. So you can see that there's equilibrium between the buyers and the sellers here. So the buyers are buying from the support level while the sellers are selling from the resistance level. So for the fact that the price is crossing above and below, above and below, above and below of the moving average, you can confirm to yourself that the market is currently in a range. So whenever price is going above and below the moving average, crossing it consistently, it tells you that the market is in a range. So in this scenario, you are going to draw a new level of support and resistance, meaning that you're going to target the highs as the resistance and you're going to target the lows as the support, and you cannot trade the support and resistance until a crossover happen or until a breakout from that level happen. Then you cannot conclude that the trend have resumed, a new trend have resumed. So but for now, the market is currently consolidating at this point. The market is consolidating at this period. So that is why the price is crossing above and crossing below the moving average consistently. So that is why I say we can use the moving average to identify a ranging market. But if you want to identify a trending market, then the price must be above the moving average or below the moving average. So from this point up to this point, you can see that the price is consecutively above the moving average. So you can see that the price is above the moving average, telling you that the market is in an uptrend. So here the price is below the moving average, telling you that the market is in a downtrend. So each time price is above the moving average, you take buy trade, and each time price is below the moving average, you take sell trade. So that is it. So now we now talk about the combination of the moving average and the trend line. Like I explained to you, you use the trend line as a confirmation. So just what we have explained here, if the market is not respecting the moving average, you can now use the trend line as a confirmation, right? Because when we change this EMA to 20, you can see that the price was crossing below it. So when we change it to 50, you now understood that the market was respecting the 50 EMA but not respecting the 20 EMA. But if you now change this EMA to 200, let's see what happens if you change it to 200. Go to the setting and then we change it to 200. So you can clearly see that the price is far away from the 200 EMA, right? The price is far away from the 200 EMA. So the long direction of the market is uptrend, right? Because the price is far away from the 200 EMA, right? So this is where the price eventually crosses the 200 EMA, and this signals a new downtrend. So since the price was above the 200 EMA, this tells you that the market is in an uptrend at the higher time frame. So because the price is above the 200, so the buyers are in charge of the market. The buyers are always in control of the market because the price is above the 200 EMA. So right now you can now use your normal price action. Because the market is above the 200 EMA, you can use your normal price action to only buy, right? So you wait for area of value to take buy trade because the market is currently in an uptrend. So this is the point where the market came and test the 200 EMA and then return back. So if you're able to cash this, right, look at it again. If you're able to cash this, you'll be able to ride this massive trend, right? So you can see that as the price came to the 200 EMA, the price tested it and got rejected. It came there, tested it, got rejected, came again, tested it, and then got rejected. So here is the perfect time for you to take a buy trade, right? But here you can clearly see that the sellers were in control, right? Because as the price breaks below the 200 EMA, the price continue going down. This tells you that the sellers have taken control of the market. So here you can see that the price is far away from the 200 because the price is in a healthy trend. That is why price is only respecting the 50 EMA but not respecting the 20 EMA and the 200 EMA, right? But if the price is in a strong uptrend or downtrend, the price will then respect the 20 EMA. So now let's go to the lower time frame so that you can now see how the price is respecting the 20 EMA. Let's go now to the 15-minute time frame and then change the setting to 20 EMA. So now you can clearly see at the 15-minute time frame the price is respecting the 20 EMA, right? You can see that the price is below the 20 EMA, signaling a downtrend. So in this scenario, sellers are in control of the market, and that is why they are pushing the price down. So here the 20 EMA is now acting as a resistance level. So each time price comes to the 20 EMA, we take a sell trade. Each time price comes to the 20 EMA, we take a sell trade. And each time price comes to the 20 EMA, we take a sell trade. And price comes again to the 20 EMA, we take a sell trade. So you can clearly see here that the market is in a strong trend. The market is in a strong trend. That is why the price is taking resistance at the 20 EMA, right? So that is why I explained to you guys that when the market is in a strong trend, you use the 20 EMA because the 20 EMA is what the price will be respecting. The 50 and the 200 is far away from the price. The price will not be able to reach there, but the 20 EMA will be closer to the price. So each time the price makes a pullback to the 20 EMA, you take a sell trade. Now let's plot the 50 EMA. Let's change the setting again to the 50 EMA for you to understand what I'm talking about. Let's now change it to the 50 EMA. So now you can clearly see that the price is far away from the 50 EMA. You can see the gap. You can see the gap. See the gap. See the gap. You can 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 see the gap. So now you can clearly see that the price is far away from the 50 EMA because the market is in a strong downtrend. That is why the price is far away from the 50 EMA. So here the 20 EMA is what the price is respecting. That is why you need to include the 20 EMA because the market is in a strong trend. So here the market is not respecting the 50 EMA, right? Because the 50 EMA is far away from the market. And if we will not change it to the 200, you see that the price is extremely far away from the 200 EMA. So let's change it to 200 EMA. So you can see that the price is extremely far away from the 200 EMA. So you can clearly see that the price is extremely far away from the 200 EMA. So when you check, you see that the price is far away. Look at it. Look at how far the price is from the 200 EMA. You can see how far. Look at the distance. Are you seeing the distance? Are you seeing the distance? Are you seeing the distance? Right? So now you can clearly see that here the price is far away, very far away from the 200 EMA. So if you plot the 200 EMA and you are waiting for the price to make a pullback to the 200 EMA, you wait and you get tired of waiting. So in the process you are waiting, the price is still going down. You are waiting, the price is going down. You are waiting, the price is going down, and this is annoying. The reason is because you are using the wrong moving average, right? The market is currently in a strong downtrend, but you are using the 200 EMA. The 200 EMA can be used when the market is what? When the market is in a weak trend, because at that period the 200 EMA will be acting as either a support or a resistance level. So if we now change the setting to 20 EMA, you will now see the price is now very close to the 20 EMA. So you can clearly see here the 20 EMA is now acting as what? As a resistance level, because price is respecting it. Each time price comes to the 20 EMA, it gets rejected. Each time price comes to the 20 EMA, it gets rejected. So you can clearly see that the price is respecting the 20 EMA. Then this strategy again can be used as a crossover. So for you to implement the crossover strategy, you can use two moving average, right? So now we have the first moving average and it's set to 20. We can now go back to the indicator and plot out our second moving average and set it to 50. We'll now set the second moving average to 50 EMA. And this time around, we're going to change the color to black. We change the color to black, increase the thickness, and we click OK. So we are waiting for a crossover, right? So you can see that each time the faster moving average crosses above the slower moving average, the price tends to go up, right? You can see that the blue line, which is the 20 EMA, crosses above the 50 EMA and the price went up, right? And here the 20 EMA, which is this blue line, crosses below the 50 EMA, which is this black line, the price went down. So this is another strategy that you can learn. So you wait for crossover after plotting two moving average, faster and the slower. So in this scenario, the faster is the 20 EMA, which is this blue line, while the slower is the 50 EMA, which is this black line. So you wait for crossover. So you see that each time the faster EMA, which is this blue line, crosses above the slower EMA, the price goes up. And each time the faster EMA, which is this blue line, crosses below the slower EMA, which is this black line, the price goes down. So you can still see it here. You can still see it here. You can see here the faster EMA, which is this blue line, cross above the slower EMA, which is this black line. This black line is the 50 EMA, right? And this blue line is the 20 EMA. So when the 20 EMA crosses above the 50 EMA, the price went up, right? So you see that the crossover happened here and the price went up. The buyers now push the price all the way to this point, right? So as the 20 EMA crosses below the 50 EMA, the price went down, right? And when it crossed above, the price then went up. So this is what we call the crossover strategy, and this works during a trending market, not during a range. So here you can see that the market is consolidating from here. So you can see that the market is consolidating from here. That is why as the faster moving average crosses below the 50 moving average, it came back again and crosses above it, crosses below it again, crosses above it, crosses below it, and then crosses above. So when the faster moving average is crossing below and above the slower moving average consistently, it signals that the market is in a range. So if you are trading based on the crossover, you are going to get so many wrong signals, because as the faster EMA crosses below the slower EMA, you take a sell trade, the price will just move a little bit and then crosses above again. You take a buy trade, the price will move a little bit and crosses below again. So this strategy will work for the scalpers. The scalpers are the only one that can benefit when the market is ranging, because they are waiting to cash small pips. So the scalpers are the only one that can use this strategy when the market is ranging, because they are taking their profit when the market moves 5 pips or 10 pips, and not day traders or swing traders who are holding onto their trade for hours or days. So when the market is ranging, the moving average doesn't work well, because there will be so many whipsaw in a range. It only works extremely well when the market is either trending up or trending down. So, but we can still use different settings. If you don't want to use the 20 and the 50, you can still use the 5 and the 20. So what we will do here is we just change the 50 to 5, and then we click OK. So here you can see that we are now using the 50, we are now using the 20 and the 5 EMA. So the 5 EMA is the faster moving average, while the 20 EMA is the slower moving average. So each time the 5 EMA, which is this black line, crosses below the 20 EMA, which is this blue line, you see that the market goes down, right? So as the crossover happened, the market went down. So you see the down move. So as you can see, as the 5 EMA, which is this black line, crosses above the 20 EMA, which is this blue line, the market went up, right? So you can see that you can change any period that you want to use, but make sure that you have 2 different periods. One should be small number and the other one should be large number, right? For instance, the faster EMA can be 5 period, the slower EMA can be 20 period, or the faster EMA can be 10 period, the slower EMA can be 30 period. So make sure that the faster EMA has a lower number while the slower EMA has a higher number. So this is how you set up your moving average in case you want to trade a crossover, because crossover helps us to know a change of trend. When the market is changing from a downtrend to an uptrend, there is always a crossover. And when the market is changing from an uptrend to a downtrend, there will always be a crossover. So crossover is a point where the traders take their trade. At the point of the crossover, that is where traders take their trade. So as the price crosses below the 20 EMA and the 5 EMA crosses below the 20 EMA and close, this is where the traders are supposed to take their sell trade, and their stop loss will be above the moving average, which is above the 20 EMA. So this is how you trade using the moving average crossover. And like I said, you must include it with price action, because if you are using price action alongside with the moving average, you'll be able to identify a ranging market. And once you identify a ranging market, you will not change the strategy, right, and stop trading crossover when the market is ranging. Because if you continue trading crossover when the market is ranging, you get so many wrong signal, and this might end up wiping out your account. So once you identify a ranging market, you stop using crossover. Rather, you use your horizontal line and draw the highs and the lows and trade off the highs and the lows. If the market goes to the highs, you take a sell trade, and the market comes to the low, you take a buy trade, right? So you know fully well then that the market is ranging, and you trade in the direction of the market. If the market is going up, you buy. If the market is going down, you sell. So that is it. You buy from the low and you sell from the high. So when you combine the moving average with price action, it's going to give you a high probability trading setup. So the tools you need is the moving average line, the trend line, and the horizontal line. So you can also use the candlestick pattern as an entry trigger, a confirmation, like if the market is going down and the price makes a retracement to the moving average or the trend line and then form a bearish reversal pattern, you can take a sell trade. And if the market is in an uptrend, make a pullback to the moving average and form a bullish reversal pattern like hammer, you take a buy trade. So you need to combine price action alongside with the moving average to get a high probability trading setup. So once you are able to master this moving average trading strategy, you'll be able to make money consistently because you'll be able to predict correctly the direction that the market is moving. So my advice for you guys is to take our time to backtest this strategy that you have learned in this video on a demo account. Backtest it thoroughly, and if it works for you perfectly, you can then use it in your live trading account. So ladies and gentlemen, that is all I have for you in today's video. I hope you love this video. If you do, give us a thumbs up. Don't forget to subscribe to my channel for more educative content like this, and also don't forget to turn on the notification icon to be the first to be notified whenever I drop new content. Remember, I post new videos every day, and the time that I always upload my video is 6 o'clock p.m. West African time. That is the time you should be expecting my new video. I publish new video every day, and the time that I upload my new video is 6 o'clock p.m. West African time. So thank you once again for taking our time to watch my video. I will see you again in my next update. Enjoy the rest of your day. Bye.